All right. Well, hello, everyone. Thank you for joining us once again this weekend or this week, and appreciate your patience here as we're a couple minutes behind schedule. But we're going to dive right in here. We've got a lot of exciting stuff to talk about and some great news, or well, some news from last Friday. So I'd like to turn it over to Sarah Russell here, who's going to kind of lead us through some of these changes. Sarah is a partner in our tax department and has been leading our PPP kind of loan understanding initiative, if you will. So she's excited here today to kind of tell us what she's learned. So go ahead, Sarah.
Thanks, Ben. Tim Hilligus is having a few technical difficulties joining the webinar today. So we're trying to get him in, and if he joins us midway through, that is why. We're just having a few technical difficulties on our side. I'm sure most people have heard that there was some guidance that came out on Friday. We're going to dive into that guidance today, but what we're going to try to do today is really sort of lay the foundation for some of the concepts that were included in that guidance. We don't have enough time to do that, as well as go into the detailed calculations that are included in that guidance. We plan to do that in next week's webinar. So if you guys ask questions that are really specifically driven by the calculations, we probably aren't going to answer those because they will be addressed next week. So I just wanted to sort of lay the ground rules today to make you guys all aware. You're used to us sort of staying after the webinar is over and answering questions. We will not answer specific calculation questions today because we are going to cover that next week. Similar to the prior webinars that we've had, the housekeeping, we will try to answer your questions real time. Ben will be facilitating that with me. And we will try to end at 4 o'clock on the dot as we normally do. So with that, I'm going to sort of dive into, where we're at. Sort of just a brief recap. Through May 16th, there are $513 billion approved. This is actually less than what it was last week, but the SBA has done a better job in the last week, sort of culling loans that were canceled, funds that were returned. There were some duplicate applications that were being accounted for previously. So this is where we stand today, still about $120 billion left in the program. And another thing that went down this week compared to last week is there's now 30,695 loans that are over $2 million, which is about 0.7% of the total approved dollars. Last week when we went through the reporting, that number was a little bit higher at 33,900. So just a couple of key statistics I wanted to point out so you guys were aware of where the program stood today and what funds were still available. So getting into the new guidance that was issued, obviously the hot topic this week is the loan forgiveness application. But we did want to highlight a couple of items that are different or that were also issued outside of the loan forgiveness. At the end of last week, or the 18th, I think it was, they issued an interim rule on treatment of entities with foreign affiliates. And we're not going to go into a ton of detail on this guidance. However, we did want to sort of address it because it was an important interim rule. There was a lot of confusion on how to treat foreign affiliates in the headcount to determine whether an entity was eligible for the program. And, if we go back to during the application process, this caused a ton of confusion. There was an interim regulation that was issued that seemed to indicate only U.S. employees needed to be included in that headcount. And so a lot of companies with foreign affiliates, whether they were foreign owned or they had foreign subsidiaries, only counted you. We think we apply or we are eligible to apply, and they did. And then FAQ number 44 was issued on May 5th, which seemed to indicate that all employees, both foreign and U.S., should be included in that headcount. So a lot of companies didn't know what to do. On the 18th, they issued this regulation that said all employees do in fact need to be counted. However, they recognized the guidance that was issued wasn't very clear. And so they sort of provided a safe harbor that said any borrower that applied for a loan before May 5th, the date that that FAQ was issued, will be deemed to be eligible if you met the head count rule based on the exclusion of non-US employees. So we had a few clients that got their applications in before May 5th. When we look at this rule, it says that you have to count all employees, but they met that safe harbor since they filed their application before May 5th, and they are eligible to apply for the loan. There was another interim rule that talked about, there's a final rule on loan increases. And this rule is really, issued some guidance. There was some conflicting guidance that was issued throughout the application process that some partners of partnerships and some companies with seasonal employees, they used the wrong guidance to determine how much maximum loan they could get. And they issued a final rule that said, if you didn't use the correct guidance, you could go back and apply for a loan increase. So it's very specific people who are eligible to do that, but that's another interim final rule that's out there. So if you're a partnership or a seasonal employer and you're not sure if you follow the right rules, know that this rule is out there and you potentially can go back and apply. There is an exception here in that the bank, the lender that you went through, they have a form that they have to submit to the SBA. They cannot have submitted that form yet. So if you think this rule applies, you probably really want to dive into it and figure out whether there's anything you need to do. All this is part of the loan forgiveness. I did want to point out, we talk about the affiliate rule, which, says if there's common control, you need to look at all affiliates. And in the loan forgiveness application, there is a checkbox, and the checkbox on that application, you have to check the box if the $2 million threshold for certification purposes is made on all affiliates. So you have to look at all companies that got a PPP loan that are affiliated and add them together. And if those amounts are over $2 million, you have to check this box. And this is how we believe the SBA is going to flag the PPP loans that they are going to review through this use of this checkbox. So those were the three items that I wanted to highlight before we dive into loan forgiveness. We start talking about loan forgiveness. I'll say the longer we live with and digest what this application says, the more questions we have. We'll talk about the issues, what issues we still think are out there. We'll talk about some questions that we've had all along during these webinars that have gotten resolved, and really, but just lay the foundation for the concepts in the application, and then next week get into the details of the calculation. I think next week the webinar will be a little bit different in that we may not have a PowerPoint, and instead what we'll be doing is sharing some Excel schedules to show how some of these computations are working. So what was resolved? What unknowns do we still have? I'm going to talk about the easier topics first, and then I'm going to get into the payroll issues, payroll costs, FTE, and compensation. So, in prior webinars, we've asked the question, what is the definition of rent? Does that include real and personal property or just real property? And the loan forgiveness application makes it clear that it includes both real and personal property. But areas that still haven't been addressed are CAM costs. We still don't have an answer on whether or not we can include those costs in our rent expense. And then there also was nothing specifically addressed related to self-rental. The definition of mortgage interest also allows for real and personal property. They don't specifically give guidance on mortgages related to personal property. our belief is probably if you have a specific loan against a piece of equipment, for instance, if you took a loan out to buy a large piece of equipment, that would be considered mortgage, and the interest on that loan would be includable for your eligible expenses. If, however, you used a line of credit, I'm not so sure that they'll trace the use of that line of credit to that piece of equipment. So, I think that there probably has to be some encumbrance there on that piece of equipment. And then the definition of utilities, we did not get any clarity regarding what that transportation costs means. However, as we have gone back and really read through the legislation that's been issued so far, we did find in one of the interim rules, and I forget which number it is, but it's the one where it is related to how self-employed individuals apply for the PPP loan. There is a parenthetical in there that gives an example of transportation costs, which said fuel costs used for a business vehicle. So I think we can, that would lead us to believe that fuel costs incurred for a business vehicle would be included in that. Propane used for a forklift or a high-low in a plant would be included. So I think those are going to be the types of costs that you probably can include, but they didn't specifically address this. We also had a lot of questions regarding reimbursed phone internet costs for our employees. I don't know the answer here, but I do think that you might hit a roadblock when trying to provide documentation to support these costs. The loan application indicates copies of invoices from February 2020 and those paid during the covered period and receipts, including canceled checks or account statements. So I think it's probably pretty clear that if you didn't start a reimbursement program until after COVID-19 stay home, stay safe order, that you weren't incurring those costs before February 2020, and those costs wouldn't be included. If you've always had a reimbursement policy, I think it's a little bit still unclear. And, in this instance, I'd probably talk to the bank to get their opinion on, hey, we have this reimbursement program for phones and internet. The employees provide receipts, and, however that happens, whether it's on expense reports or goes through payroll, what type of documentation would you ask for to support those costs? That's probably how I would approach it, unless we get guidance that tells us clearly that they're not included in your utility costs. And Ben, I'll just say, if you see questions pop up as I'm going through, don't hesitate to interrupt. So if we talk about paid and incurred, we talked a lot in the past webinars on this paid and incurred concept. And there was some guidance on this. The guidance allows what I would call a modified accrual accounting concept. And I say it's a modified accrual accounting concept because it's clear that both for payroll costs and non-payroll costs, that amounts paid are included, but they've also sort of carved out an allowance for amounts incurred during the covered period, as long as they are paid, for non-payroll costs on or before the next regular billing date. So if you have, you get your utility invoice, but it's not due until 2 weeks after your covered period, as long as you paid it by that date that it's due, you would be able to include it. And they did the same thing for payroll costs, and they made payroll costs a little bit more complicated, which we'll talk about in the next slide. But I will say in the payroll costs, there's a little bit of an inconsistent use of the words paid and incurred versus paid or incurred, which can really result in a big difference. Payroll costs, they said payroll costs are considered paid on the day paychecks are distributed or an ACH transaction is originated. And payroll costs are considered incurred on the day the employee's pay is earned. So this would lead me to believe that potentially, you could have a covered period that starts on May 4th and a payroll run that is issued on May 5th. And the way they've worded this seems as though potentially that May 5th payroll would be included. I don't think that's the intent. And I think as you look through that loan forgiveness application, what you'll see referred to very frequently is that it's supposed to be 56 days of payroll. So even if you did include that, I think there'll be a limiter on how much payroll you could include in this payroll cost. And I think it's going to be 56 days. But the way this language is written is a little bit confusing, and I think still leads to some questions on how we apply it. So they introduced a new concept for payroll costs because we didn't have enough questions. They added a new concept for everybody to get familiar with, and it's this concept of alternative covered payroll period. And it's borrowers with a biweekly or more frequent, so either a biweekly or weekly payroll schedule, may elect to calculate eligible payroll costs using an 8-week period that begins on the first pay period following their PPP loan disbursement date. So, potentially if you got your disbursement on May 5th and your next pay period didn't start until May 10th, your 8-week period for payroll purposes only could start on May 10th. But this is only applicable for borrowers who have a bi-weekly or more frequent payroll schedule. So if you have a bi-monthly payroll schedule, you are not allowed to elect this alternative covered payroll period. The loan application does confirm that $15,385 is the maximum amount allowed per employee. What's not clear when you look at that maximum amount allowed is whether it matters if the person was on payroll for all 8 weeks. Do you annualize it? We know the $15,385 is a weekly annualization of $100,000 salary. But if you had a person on payroll for only 7 of the 8 weeks, would your maximum allowed be less than, would it really be the 1923 times 7 instead of times 8? That has not been made clear. So I would say that that's still uncertain. What else is uncertain is whether employer health insurance contributions are net of employee premium share or if they're gross. I think Tim and I both interpret the language that's in the loan forgiveness application differently. And if we can't come to a conclusion together, I would say that that's still unclear. So we hope for a little bit more guidance there. And then when we look at retirement contributions, it's still unclear if you can include amounts other than those that would be normally contributed during a pay period. So if you have a 4% matching contribution that you contribute with every pay period, it's clear that those will be included. But as we've talked about in prior weeks, the retirement contributions that you may make as a profit sharing contribution at the end of the year, can that be included if you pull that forward into this covered period? If you have it made your 2019 profit sharing contribution, can you pay that during the covered period and have that be a qualified cost? We still don't know the answers to those questions. So you'll see, while we got some answers, which is great, we still have a lot of questions remaining. And I think there's still a fair amount of guidance yet to come here.
Sarah, so before you move on, I think one of the top rated questions that we have right now is talking about the alternative payroll covered period and how that relates to the covered period for non-payroll expenses. So things, kind of going back to covered costs and utilities, I believe is what that question might be getting at.
I'm sorry, could you repeat that?
Yeah. So the question right now is, does the alternative payroll covered period define the covered period for non-payroll expenses? So, I think that might even extend to, some of the business expenses we were talking to earlier. So how do those two concepts work?
So the alternative covered period is for payroll costs only. That includes all payroll costs. So it'll include your compensation, your employee benefits, and your retirement contributions. However, rent and utilities and mortgage interest are still the regular covered period. So you only have the 8 weeks to spend the money on those non-payroll costs. this alternative covered period is only for payroll costs. So if we get into FTE reduction, we had a lot of questions in the past. What if I try to rehire somebody and they don't take my rehire offer? We got some relief on that we talked about in our last webinar, but there were still questions. What if somebody resigns? What if I have an employee die? What if somebody retires? Are these people going to count against me? And the application provides exceptions for these types of events. So you could fire an employee for cause if an employee voluntarily resigns, if you have hour reduction or voluntarily takes an hour reduction. These people do not count against you in your FTE reduction calculation. You sort of, it has you add them in as an FTE exception. So you would still meet that FTE number without those people there. And I think that, if we look at this, that this would apply also, they specifically talk about employees fired for cause and voluntary resignations. And we already know that if somebody declined a rehire offer, that we didn't have to include them. I would say that this would also include somebody who died or retired. A retirement would be a voluntary resignation. And I think a death would also fall under this exception, although not specifically stated. The FTE rules in the loan forgiveness application, they define an FTE as an employee who works at least 40 hours, which is different from what we were assuming would be the FTE rule, which was 30 hours, as that is generally what an FTE is defined as in other areas of labor employment laws. But it's been clear that this is 40, it's a 40-hour person. And you take the average number of hours paid per week, divide by 40, and round to the nearest tenth to determine how much of an FTE each person is. You cannot go over one. And they allow a simplified method that you could take 0.5 for employees who work fewer than 40 hours if you wanted to simplify that calculation. I would say if you have a lot of part-time employees and they're working, they're all working 30 hours, so they're all working the same amount, you may be okay. You may not be harmed using this simplified alternative method. But if you have some employees who work, 20 hours, but some who work 30, this using the simplified method could harm you, because somebody who works 30 hours would really be at 0.8 because you round up to the nearest tenth. So you really need to look at how you're doing this calculation. If I look at these FTE rules, I think that there's still a lot of questions. There's really no guidance on how the safe harbor restoration rule operates. The questions that I have are, is this just a one-day test? It's clear in the legislation that if you rehire employees by June 30th, it is as if the layoff never happened, and you can count that person as a full-time FTE in your count. But do you really just need to hire them for June 30th? Is it based on a payroll ending June 30th or a payroll starting on June 30th? Is there a period of time that these employees need to be rehired for? If you hire an employee during the covered period with a midweek start, how will that person be counted? So I think that there's still a lot of detailed guidance that we need on here. I think they've gotten a good start to at least have people able to start projecting where their loan forgiveness is going to end, but I still think that there's a lot of detailed questions that we need answers to. If we talk about compensation reduction, Tim alluded to this in the last webinar, and it was sort of at the end where I was a little bit confused.
Poorly.
I wasn't sure exactly.
Poorly. I alluded to it poorly, Sarah. I completely confused everyone. Yeah.
Including myself. But, sort of after we circled back after the webinar, we sort of talked through it, and it came to realize what he was talking about. So in the legislation, there is an exception that says when you're looking at who you need to count for compensation reduction, you only need to account employees who made $100,000 or less. But the specific language says as annualized for any pay period, which would lead you to believe that if you had an employee who for one single pay period during 2019, if you annualize that pay period, they would make more than $100,000, they could be excluded from this compensation reduction, which is probably not quite the spirit of the law. And I think the key here is going to be how they define the term salary, because there's compensation, which includes salary, wages, commissions, bonuses, etc. And so are they defining salary just to mean, this is your annual salary, plus you have, some incentives that are outside of that? Or is that definition going to include all types of compensation? And I think that's the key when you're looking at this rule. And I think it's going to apply, it will apply in other areas, such as when you look at the loan forgiveness application, there's two tables. And the first table is for employees that receive less than $100,000. And the second table is for employees who receive more than $100,000. And there's this, it's still with this annualization concept that we're talking about. But if we look at the loan forgiveness application, it's been made clear that that first quarter, and we had previously said we don't know what that means. Do we just look at, because it said the most recent full quarter of payroll, and we weren't sure if that was going to be a trailing quarter or if they were just going to use Q1 as we normally define it, to be January 1st through March 31st. And they've clearly defined it to be January 1st through March 31st, which happens to be a time frame that a lot of companies pay out bonuses that are really related to 2019 performance bonuses. Companies accrue those at the end of the year, and then they pay them out generally before March 15th. And so, you could be in a situation where you're paying those bonuses out, and that sort of skews what your average annualized compensation is for that quarter. And your 8-week period clearly wouldn't include that same bonus. So I think it's going to depend on how they define this term salary. My hunch is that term will be defined the same for this clause in the application that talks about at an annualized rate of more than $100,000 for any pay period in 2019, as it will be for filling out this table that we're referring to in the application. I think only time will tell if they provide us more guidance. I hope they do. If they don't, I think everybody's going to have to, sort of do their best and make some decisions on how they want to interpret that term. But I would say the best thing that you could do is be consistent with it at this point. Tim, do you have anything to add there?
No, sir, I'm good. Thank you.
Okay. So we just wanted to briefly talk about, some of the documentation requirements that are included in the application. If we look at payroll, it talks about bank statements of third-party payroll service provider reports documenting cash paid to employees. They want tax forms or equivalent third-party payroll provider reports for the periods that overlapped the covered period, or the alternative covered period, which would be 941s or state quarterly reports, payment receipts, canceled checks, or account statements documenting the amount of employer contributions to both employee health insurance and retirement plans. I think the big takeaway on this one is for borrowers whose 8-week covered period or alternative covered period extends beyond June 30th, the requirement for quarterly payroll tax filings will delay when they can apply for this loan forgiveness, when they can submit this loan forgiveness application. Because, if your covered period goes into the first week or the second week of July, you're now in Q3. And so you would have to wait for your third quarter 941 to be ready to submit this documentation. They may clarify that to change that. They may accept, a trailing report from your third party payroll provider. I don't know, but that seems to be the end result based on the loan forgiveness application today. If you were one of these few who are getting access to the funds right now, and clearly your 8-week covered period is going to go beyond June 30th. Other documentation requirements, so that it's explicitly indicates in the forgiveness application that for your full-time equivalent documentation, you'll have to provide payroll per, the average documentation showing the average number of FTE employees on payroll per month employed. Documents include payroll tax filings for what will be reported to the IRS and states on your payroll tax filings. The application is that documents may cover periods longer than the specified time period that you really need to report for. But there is no indication on what reconciliations they will require, both on this and your payroll, right? I mean, if you start with a full quarter of payroll and what you're claiming for forgiveness is only 8 weeks, it's pretty clear that there's some reconciliations that will need to be done for the banks to be able to tie those numbers out, but we're still not really clear as to what the banks will require or what the SBA will require from the banks. And then if we talk about non-payroll documentation, it's sort of the same things that we've been talking about. For business interest payments, copy of lender amortization schedules and receipts or canceled checks verifying the interest payments from the covered period. They talk about lender account statements from February 2020 and the months of the covered period plus 1 month. I think that additional month is to account for any payments that were made after the covered period, but before that billing date came about, to sort of prove that, yep, you did in fact make that payment on time. And similar for business rent or lease payments, it's, copy of the current lease agreements and receipts or canceled checks verifying those payments were made, or lesser account statements from February 2020 and the months of the covered period plus that 1 month. If I think about a self-rental, a lot of times some of our small businesses don't do a great job of drafting lease agreements for those self-rental entities. And if you don't have a lease agreement, are you going to have a problem supporting your, lease, your rent expense for this application? Or will they really just take canceled checks and, take sort of an implied lease agreement with proof that you've been paying the same lease payment for a period of time? I don't know, but I think that if I didn't have a lease agreement, I'd at least be concerned about that. And then business utility payments is the same, copy of the invoices from February 2020 and, canceled checks and account statements verifying those eligible payments. And I just want to point out that the February 2020 date is in here because if you didn't have utility services or a lease agreement or a mortgage by February 15th, 2020, those amounts that you pay are not qualified because you had to have those things in place before February 15th, 2020.
Hey, sir, I want to chime in on this a little bit because of the 7,000 questions we received, 6,999 of them are the hypotheticals if I pay for my employees' cell phone or internet bills. Now, I would think in general, those are utilities. The problem is going to be if your bank asks for information, you didn't have a policy in place before February 15th to reimburse your employees for their internet or their cell phone bills. It's not likely that the bank's going to accept that. So that I kid you not, there are hundreds of questions about that particular item for the reimbursement of cell phone and internet. By all means, do I think it's necessary for companies to make sure their employees can have a successful remote working experience? Absolutely. The hard part's going to be, is it really a forgivable item? I would think it's a absolutely, well, maybe not absolutely. Maybe I should ask you this. Would you think it's a qualified use of the funds? I would
think it's a
Yeah.
qualified use of the funds. I mean, we sort of, I don't know when you were able to finally join, but we sort of touched base on that at the beginning that, I think that it's probably relatively clear that if those policies weren't in place before February 15th, that as the rules are written today, they wouldn't be qualified. Right. I'm also a little concerned if those policies were in place before February 15th, how much heavy lifting to get that documentation are you going to have to go through? Because, maybe easy if it's to go through expense reports, I don't know, but if it's, sort of a fringe benefit included on a W-2, and they just get an allowance, might be a little bit more hard.
I mean, to me, the one trump card you have is if you did treat it as a taxable fringe benefit and included in their wages, now it becomes payroll in the 8 weeks, right? I mean,
yeah.
There you go. So if you're paying the $80 internet bill and you put it in their wages in the 8 weeks, it's $80 forgiveness potentially, in the forgiveness calculation. Yeah. Of course, it's now $80 of taxable income, but your employee's got $80, so you can kind of look at it as maybe the way to absolutely make it potentially forgivable is to include it in their payroll.
Yep. And I would just say, I think last week we got a lot of questions asking, well, what if I paid to help my employees get set up at home? I bought monitors or bought an office chair or whatever it was that the employee needed. Those are not qualified expenses for this program. So those would not be included unless we got guidance that gave us a little bit more lax on a utility definition. Those types of expenses are still, they never were part of the program, and so they still are not. So the answer to those questions are still no.
Question that keeps coming up is, when do you apply for forgiveness? And I'm thinking that there's really there's no too soon, other than, well, maybe there is a too soon. But when you think about, each company is going to have their own specific circumstances. Some may meet all the requirements and have all the information at the end of their 8 weeks, and some may be waiting till the June 30th of safe harbor. So I think each circumstance will be slightly different on where you're at. I think the key thing is you would have to be able to complete the forgiveness application and the supporting documents, and that would be a minimum before you could apply for forgiveness.
Yeah, I mean, one of the things that's not included in the loan forgiveness application or the instructions to the loan forgiveness application is the due date of the application. So very basic information. They've given no timeline as to when there's no deadline as to when you must apply for forgiveness, and there's no guidance as to when is the earliest at which you could apply for forgiveness. So that's still a pretty big question that I have. I read some articles that had indicated they thought the banks would start asking borrowers to start providing their documentation, around week 7 of this 8-week covered period, so that they can do the work that they need to do in the back end and be ready to go with that application once it's finalized, because the banks do have a limited period of time as to when they can issue a determination upon forgiveness, and that time frame is only 60 days. So I do think that the banks will have some incentive to want to get as much documentation as they can up front, while some of these trailing issues still get sort of resolved with this June 30th deadline. And people will still have that flexibility to rehire to actually determine final loan forgiveness. But I think it'll be easier for the banks to sort through some of them. There's a lot of documentation that needs to be submitted. And if they can start sorting through some of that earlier rather than doing it all at the same time, the better off they're going to be able to meet that 60-day timeline. So, going back a little bit to compensation reduction, there's some other issues here. I talked about it a little bit, this reference period being January 1st, 2020, and the bonuses, and just sort of reiterating that this average annual salary definition, I think, is going to be critical. And, I don't want anybody to overlook it. I think once you start going through and actually plugging in numbers, if you just use weekly salary or weekly compensation as paid, and you plug that in and you divide by 13 and multiply that by 52, your result could be different than if you just take general salary and don't include commissions or bonuses there. And I think that's true both for determining what your real if you really had compensation reduction, right? Because in that instance, you could be in a situation where you didn't reduce anybody's salary. Their salary was $50,000 on January 1st, and their salary is still $50,000. You had no salary reduction. But if you put the wrong numbers into that calculation, if you included a bonus, for instance, that got paid out sometime in that first quarter, the calculation would show that you did have a salary reduction. Now, maybe it wouldn't be 75% and you'd still be okay. But if there was a large bonus out there that skewed somebody's numbers, you could be in trouble when you didn't think you were going to be. I don't think that's the intent of this rule. So I'd be surprised if that's how that plays out. But I just wanted to caution you, because I think sometimes we get information and we start just sort of inputting the data as fast as we can to see where we get, and then you get a surprise at the end. And this would certainly be one of those situations that could surprise people if they were entering data this way. And again, just reiterate, assume that the definition will be applied for this reference period the same as it will be applied for what we talked about, this $100,000 issue where, annualized for any single pay period. I think it will be applied the same, but that I could be wrong, because I will say the CARES Act specifically has that language for people who you are able to exclude from this calculation. So we'll see. Right now I'm sort of looking at it and doing both. If we exclude all these people, what's your result? And if you include the people that you think should be included, what's your result? And is it significantly different? So just some final thoughts. There's a lot of information in this loan forgiveness application, and there's still a lot of questions. We thought when it first came out, I thought, oh gosh, this is great. They've answered the paid and accrued or incurred rule. We now have a little bit of flexibility with payroll so that it can be a little bit more administratively easy to figure that out. But the more I live with it, the more questions I have on these details. There's no change to that 75% must be spent on payroll. Your eligible forgiveness amount will be limited. You have to spend at least 75% on the forgiveness amount for payroll. That hasn't changed as we had hoped. There's some indications that could still change, but right now that's the rule we're living with, and I think that's the rule you have to assume is going to be applicable in the end. Trump did say yesterday that extending the time frame to utilize the funds from 8 weeks to 24 weeks should be easy. This will take a congressional act to amend the CARES Act, because that is a part of the legislation. It wasn't a part of Treasury or administrator guidance. It was in the actual act. However, Rubio did announce today that they have the votes to do it. So he has a little bit more optimism that extension may in fact happen. I wouldn't be surprised to see some sort of an extension happen, but maybe only be applicable to those businesses who could not open, and give those businesses a little bit more flexibility to start working through the new sort of normal as they are able to open their doors back up. And, you think, I'm talking about more restaurants and hotels and tourism industry type of businesses, but certainly applicable to the manufacturing facility who, in Michigan couldn't open until I think 2 weeks ago. So we'll see what happens there. I do know that it was part of the proposed HEROES Act to have an extension on this. That's not going anywhere in the Senate. I don't think that they're going to be voting on that. I think any bill that comes out will be changed dramatically from what's included in that act. And it's been clear that the Republicans don't have an appetite to try to push another stimulus bill right at this moment. They sort of want to wait a little bit to see how the first 3 phases of stimulus that they issued over the last 2 months or so, how they really impact the economy. They feel like it's a little bit too soon to tell. I think what we can count on is that we will continue to get guidance relative to loan forgiveness in the form of FAQs, interim final regulations, and perhaps new or amended legislation. I had a client say to me last week that he's getting pretty frustrated about this loan forgiveness, and he sort of feels like he's playing a basketball game where he thinks he knows where the 3-point line is, but he's not quite sure, and they'll tell him at the end of the game how many 3-pointers he scored. And it sort of feels like we're living in that type of world where they're moving the line on us as we go, and we're not exactly sure where it's going to end up. Tim, any thoughts you have?
I mean, I apologize for not being into the system, because I had kind of some of those witty comments that I have. I know everybody's probably excited that I wasn't there, but when you think about the only thing certain in life, death and taxes, and I think there's a new one now, and that's the PPP will change. And for those who have kids at home, I am glad that this was not a payroll program, because the giggle factor in my house, if this was a 2P program instead of a 3P program, would be totally different with a 10-year-old and 11-year-old. But the fact that this is constantly changing really makes it difficult. And I wish, I keep referring back to when we used to do these live and we could see everybody, and I wish I could get a sense of if people are asking us for their blessings on their hypotheticals or they really don't know, because some of them are legitimate hypotheticals and some seem to be, kind of the outstretched arm of, everybody wants to get the most forgiven that they can. And unfortunately, they're just not, the government's not geared around thinking of every hypothetical that you have. And that's something the three of us deal with all the time, and to be candid, we get a better shot of it when we're dealing with tax literature, where you have code, regulations, rulings. I mean, there's so many benefits to the tax system that really weren't integrated into the SBA system. And I think of the worst thing that happened this week for some of our clients was the 12th interim final rule that came out on Monday morning. It basically said within this program, 2 different companies with the same fact pattern could have a different result depending on if they applied for their loan May 1st or before, or May 5th or after. I mean, imagine that's what we've got to here is, on the positive side, for people who are relying on these interim final rules as we go through, they seem to be sticking with it. In this case, they're sticking with what that rule said. But the scary part for me is they basically picked the point in time when they issued the frequently asked question on May 5th and said, on that day when we changed our mind and issued the frequently asked question, you should have treated our frequently asked question as law. And that's not something most of us are used to dealing with. When you're given guidance, especially in these hypotheticals, where you can't be black or white with words, you rely on the hierarchy of the interim final rules are law or interpretation of the law, and frequently asked questions are not. So it really is difficult.
Yeah, and you know, one of the things that I think is confusing out there, and we didn't touch base on it because I'm really hoping to get more clarification before I alarm people, but this concept of being owner, you know, an employee owner, and what is included and how do they count for FTE purposes. It seems as if the SBA is going in this direction that they're sort of a separate category of employees for an S corp or even a corporation. You know, we're used to that if you're, you know, a Schedule C or a sole proprietor, and even sometimes in the partnership world, but they seem to be including in that corporate employee owners. And there's, you know, I read some articles out there that seem to think that the rule that health insurance and employer contributions for employee owners wouldn't be included. That doesn't quite make sense to me. You know, it makes sense why maybe a Schedule C wouldn't have those included because those are clear deductions on their personal return. But for it not to be included for an S corp shareholder or a C corp shareholder doesn't seem like that's really the case. But I don't know where that will end up.
Yeah, I think that you know, and just to kind of make sure everybody understands this, as we move closer through this application for forgiveness process, more questions are going to come up. You know, for example, Ben had a chance to analyze another resource out there. The AICPA came out with their own calculation, and you know, there may be something in there where their formula was different than what we interpret the formula to be, or the direct PDF version of the instruction. So I think as the SBA gets feedback from professionals like us and others, hopefully we'll get some better definitions. A great question just popped up here, and that is people who earn draws or take draws on commissions. You know, you run them through compensation and maybe you true up later in the year. I think those are people that have to calculate the actual commissions during the 8 weeks. I don't know that I change my draw system, but I need to know what's the amount that's eligible for forgiveness in that 8 week period. What's the commissions that are actually incurred in that period, not necessarily paid?
Yeah, I don't know. I mean, because they do use this definition of, you know, I talked about this a little bit at the beginning, paid and incurred, you know, especially as it relates to compensation. It's not consistent. Some places it says paid and incurred, and some places it says paid or incurred. And then they, you know, clearly define paid to mean when the paychecks are distributed. So you could end up in a position where your disbursement came out on May 4th and your pay run came out on May 5th, and that's includable. I think the limiter there will be, there is also that concept of 56 days being included. So I think, you know, originally when I read that rule, I thought, well, shoot, could you, because it was paid a day after disbursement. And then on the other side, we have this incurred rule that talks about as long as the payroll was earned during the covered period, it can be included as long as it's paid in the next pay period. So if your payroll timed out properly, could you end up with 10 weeks of payroll almost to be included in that time frame, if you will? I think that that's not going to be the case. I think that it's clear that they intend it to only be 8 weeks worth of payroll. And so however that ends up for you, you know, will maybe a little bit different, but I don't think you'll be able to sort of navigate that system to end up with 10 weeks.
Okay. So I am reading through, we got about 5 minutes left. I'm reading through some of the questions, and again, I apologize for those out there. We didn't have our normal housekeeping, so maybe I'll mention a couple things. We're continuing these every Wednesday through the month of May. We're hoping to get deeper into the actual forgiveness calculation and continue to bring updates at the start of every one of these meetings about what's changed or what have we learned from the prior events. So from that perspective, we're going to continue on. We're going to try to continue to answer most of the questions that come up, but if we think it's a specific question that might be covered as we get into the details, you know, don't shoot us for tabling your question or not answering it. Sarah and Ben and I have stuck around in the past, the past seminars, and we're able to answer pretty much all the questions. In this case, we might just table some of those questions or bring them into our discussion or for next Wednesday when we go into our second week of having this forgiveness calculation. But I'm gonna use that to lead into a question that somebody asked her. Did you cover the fact that rent is personal and real property, provided that a lease was beautiful? Okay, just wanted to make sure. Just wanted to make sure as people are chiming in. Sometimes they throw their questions out there. I almost feel like we should have a seminar and then have an hour of Q&A afterwards, because we get so many questions before we've even started, and we certainly appreciate all those questions. So I like, somebody just asked this question: will the IRS accept the answer that Clayton and McCurvey told me so? I don't know what you guys are talking about. None of my clients pay taxes nor file tax returns, so I'm not sure what this IRS thing is here.
I guess that means that at the start of all of these webinars, we need to start in the housekeeping section with the clarifier that nothing we say on these webinars should be taken as legal or tax accounting advice.
Well, now you did mention that you and I actually have some areas where we may disagree on the amount allowed for forgiveness. So I think there's a further criteria, which is people may want to take my advice versus your advice, which they're welcome to. But in the end, I suspect it's going to get blacker and whiter and blacker and whiter, and we're going to know some of this stuff a lot better. I would expect before people are submitting forgiveness applications, most of these hypotheticals are certain or will be more certain.
And I think in the end, too, it's important to remember that while Tim and I and Ben can, think that we have a lot of the answers and we're interpreting the language clearly and, sort of provide advice, I'm trying to get the bankers who are ultimately in charge of determination on this forgiveness involved sort of earlier rather than later, so that we don't think we're doing the right thing and the bank says, when you go for application, no, we don't interpret it that the same way. You want to get them on your side earlier rather than later, I think.
Very good. All right, we are at 3:59. Please, if you're able to stay online, we have quite a few hundred here participants still online. We'll probably continue to answer a few questions. And like I said, please save the date for May 27th, 3 o'clock. We'll get through this. We haven't discussed specifically, but my anticipation would be, as I said before, continue to better define through the information we get through the SBA and the Department of Treasury to answer these questions. And hopefully before we get to the end of this, before we get to end of anybody's 8 weeks, we'll have resolved what open items there are. I think, by the way, I can't say enough about making sure you stay in contact with your bank. Somebody asked the question, do I really have to do these calculations if I know the answers? If I know I didn't reduce my payroll? Well, it's not just what you know, it's what you can show to your bank. So every bank may have a different set of criteria. We know the foundational criteria that they're requiring in the forgiveness application, but I've had several banks through the application process for the loans ask for a very broad range of information. And so if a bank wants to be safe, they may ask for more than less.
Yeah, and I will say, if you look at the application, there is like a checkbox. Did you have a 75% reduction? And you may be able to check that box no, but I think you need to be able to be prepared to support that. I think there are some instances where the more complicated calculations you do not have to do if you didn't have FTE reduction or a compensation reduction, but I do still think you're going to have to be able to support that conclusion with other type of conclusion.
All right, so we're going to have Brian kind of shut our microphones off. You may see us, or I think you may even turn our cameras off. We're gonna shift into answer mode and kind of get this thing ready to be released out there. I would say, please check our website for the contacts. A lot of people asked for the resources, and I believe we provided those last time, but I know they're on our website for treasury.gov. That basically takes you to the links for the payroll protection program, the interim final rules, as well as the frequently asked questions. So thank you, everyone. Look forward to seeing you next Wednesday at 3 o'clock.